So without further ado, I invite Mr. 𝘸𝘱𝘭𝘥 to give his introductory speech on behalf of the Malta Chamber. Thank you.
Thank you, Julia. Good afternoon and welcome to another webinar organized by the Malta Chamber in collaboration with HSBC, titled Opening Up a World of Opportunities, Exploring Structured Trade Finance Solutions. Thank you, Mr. Andrew Robinson and Mr. 𝘠𝘰𝘳𝘭𝘥 for joining us today. From my end, trade finance is a bit of a subject which I always liked. I see it as a toolbox in our business, and it helps. It's a tool to help businesses grow. If I go back a long time, before I started my career as an accountant, at the time in Malta there was what was called a pupil worker scheme, where you'd be studying and you do a short stay within the bank. And I worked for Midmet Bank way back in the summer of 1988 as a pupil worker in what was called the Foreign Exchange Department, where these type of transactions went through. So the first time I heard things like bills for collection and similar terms. However, in recent years, with even 𝘠𝘱𝘭𝘥 on this call, working also with him, I've had some positive experiences implementing a number of trade finance tools in the company I work for. And I have to say it is definitely a way to finance a business in certain circumstances, and I'll expand a bit. There are a number of instruments that one can use. I'm not the expert, so these are the experts, but which are beneficial for companies that are looking to internationalize, companies who are looking for financing their working capital. You can have things like letters of credit, bills for collection. These two are normally associated with countries with low levels of trust, but not necessarily. There could be different reasons. Invoice discounting, both your sales and purchasing cycle, financing against the assets of the company, your receivables and your inventories, and there are not so many different variants of these instruments. I would say my experience in the last 2 years of working closely with HSBC has been really positive, not just in Malta. So I've worked outside of Malta with HSBC, and where you have international customers on the trade finance invoice discounting side, with companies especially of a good repute, with good credit ratings, I would say, and that tends to help significantly, because that is where you can use the name of the customer as your collateral, as your security. So looking at invoice discounting, I would say, just to share a bit of experience, it is a tool that is possibly timely and costly, slightly costly to set up at the beginning, but then as you go along, it's really can work really well. And also the interest rate, and the interest is, let me say, interesting at this stage. So a typical example we use is we discount invoices from a number of different companies we work with. We get 90% upfront at the time of the sale, and then once the sale is complete and the customer pays, the 10% comes at that point in time. Traditionally, Maltese companies tend to look at financing of a business working capital by using things like overdrafts, and you get hypothecs on your assets, on your special hypothecs on properties. Whereas invoice financing, which is what I learned, is you're actually using the customer name, using the customer's creditworthiness as your security. Typical example that we have in a company I work with, we would sell to a company like Chanel, which is a big name in France, it's huge stability, and you are able to use that name to discount and use that name and that creditworthiness as your security. So I have to say that is something which I have found to be a very effective tool. The beauty of such a tool is the flexibility. So you can increase or decrease as the business changes. So, for example, recently we saw the impact of COVID. Some businesses did suffer. So you can actually tailor and reduce the size of your facilities in line with your business levels. At the same time, or more importantly, is used as a scaling up tool for businesses that want to grow. So as you grow, as your working capital grows, as your sales grow, you can tailor the size of your facility in line with that growth. So I consider it as an essential tool for companies that want to internationalize, that want to grow, and they're looking for financing their working capital. And a company does require proper discipline and process and documentation in this area, but clearly it is definitely, in the case of 𝑘𝑠𝑡𝑡, that discounting one tool in the trade finance portfolio that can be used to scale up businesses. So I'll leave you to Gaetano and Andrew Robinson, who I'm sure will have give us a very interesting insight into the trade finance cycle. I'll pass over to Julia, and then later on maybe we can take some questions as well. So over to you, Julia.
Thank you very much, Nick. Thank you so much for that. So I just want to remind you that the Q&A is still open, so I do invite you to click it so that we can present the results later on. Just let me go through the questions just so you have an idea what we're talking about. The first question is, do you expect your use of digital applications by your business to develop resilience of my supply chain now and into the future? And which section of your trade cycle engages and ties up with your working capital for the longest time? So like I said, I do encourage you all to answer the poll that we currently have in progress. Mr. Samout, I pass on to you. The floor is yours. Thank you.
Good afternoon. Thanks for sparing precious time to attend. Shall I share my screen, Julia?
Yes, of course, not a problem.
Just to reassure attendees, we don't intend to kill by PowerPoint, so it's just a couple of slides. Hope you're seeing that.
If you could just increase the size, so put it in full screen, please. Okay. So that we can see everything better.
Better?
Yep, great.
Right. Good.
Thank you.
So I'm the country head of Global Trade and Receivables Finance in HSBC, and I'm trying to sort of be the introducer to Andrew, who comes after me here. Andrew will give us a global perspective, an international perspective, and he is very well placed to do that because he is the head of business development and sales for HSBC's European region, as well as being the head of commodities and structured trade finance. Hopefully all these titles will be explained as we go along. So what are we talking about? I mean, if you see this slide here, we're going to be talking about this basically all the time. Bits of it, the whole lot of it. Most of the attendees will see it as a very familiar something which they live daily, they live day to day. So what happens when you start a business? You source your material, you source your raw materials, you source your supplier, you pay for them, you wait for them to arrive, then you start manufacturing, distributing, stockpiling, inventories, whatever. Then you arrive at the seller side of the story, of the equation. Whether you're an exporter or a local seller, it doesn't really make a difference. Whether you're a manufacturer, whether you're a service supplier, what we call in HSBC, the trade cycle will be part of your daily bread and butter. It's the logistics side of it, so the attention to all the details and the administrative side, and where we come in, where the banks come in, is the funding and the financing of the trade cycle. So once you get to the exporter seller side, you've got your raw materials, you've got your labor in order, you start producing, you start adding value, and then you start receiving your own orders from your end buyers. And pack it up, deliver it, ship it, and finally the last stage of the voyage, and the most important one, is invoice it and wait for the payment to come through. So these are all individual to and different from one business to the other, and even in some businesses there will be 2 or more different trade cycles if the company is sourcing from different geographical locations or selling to different geographical locations. So the cycle tends to be sometimes slightly different, sometimes very different. So basically what we do, we sit down together with the client, start to identify the days and the months in each stage of this trade cycle, and seek to plug in solutions and seek to have an overall solutions by plugging in, as Mr. 𝘱𝘱𝘭𝘥 rightly said, our toolbox. The idea is to arrive at a holistic solution. Obviously, we see what the customer needs are, and finally, what the customer requirements are. So, no rocket science, right? This is the lives of any business every single day of the working year. So switching to the toolbox, to quote Nick again, because I like that phrase. So we have various, obviously, tools to plug in into that famous trade cycle. Some solutions will require one tool, some solutions will require more than one tool, some solutions will require 3 or 4. And the main ones we use, without going into detail, because to put it into perspective, GTRF, that's Global Trade and Receivables Finance, Malta, we have something like 32 different products, so it's not the intention to go through them. Obviously, Andrew will have probably more than double that, having to cater for the whole of Europe. So the 4 main ones would be, in brief, and I need to thank Nick here because he did this bit for me, to be honest. So letters of credit, so that would be at the order stage or even pre-order stage sometimes, where you mitigate your risk. If you're on the import side, you mitigate your supplier risk. If you're on the export side, you're mitigating your buyer risk. Letters of credit, apart from the usual risk mitigations, can be used as well for funding, financing by being discounted or negotiating and accessing your cash faster than waiting for the document for presentation to be done and payment to arrive. Next in line is international, even local guarantees. So guarantees sometimes starts quite often before the trade cycle. So if you're sourcing from suppliers, you probably need to contract before you start putting in your actual hard purchase orders. And most people would require some sort of guarantee up front to tie you into minimum order levels and such things. So in guarantees, I believe we are very well placed here. We are a bank with 60 plus sites all over the world, plus a very vast correspondent network. So to reissue or issue guarantees with us, we should find a solution anywhere in the world. The good thing when using our own, as I said, 60 plus sites is that we know the flow is much simpler, much faster. We talk in days instead of weeks or months. And you get on all-on pricing at the application stage. You're not going to get any nasty surprises later on by a third-party corresponding bank claiming a huge sum of money to reissue your your guarantee wherever in the world you wish to reissue it. Coming to trade loans, again, this is one of the most valuable tools in our toolbox. They are very flexible in their usage, whether buyer trade loans, which typically fits importers, or seller trade loans, which typically fit exporters. They bridge the gap between the payment for the imported goods and obviously receipt of funds from either subsequent sales or discounting invoices, etc. trade loans quite often are used post letter of credit. So when your letter of credit, if you're on the buying side, you're on the importing side, comes to mature and you need to pay it, sometimes we plug in a trade loan to cover the gap between actually shelling out your cash and receiving it from your buyers. So very flexible and useful tool, both for imports and for exports. Finally, we come to receivables finance. So you have an asset in your balance sheet, the debtor portfolio, and you can very quickly improve your cash conversion cycle over the trade cycle of your business by immediately monetizing those invoices, those receivables. As Nick said, up to usually we advance or discount up to 90% upfront, with the other 10% being given to the client when the invoice is actually paid. Apart from the cash conversion, receivables finance are very useful for removing risk from the balance sheets by using non-recourse structures. Obviously, these will mitigate the buyer risk from businesses, and obviously improve balance sheet, things like leverage, things like gearing ratios, and so on and so forth. In a nutshell, what we are doing with these solutions by plugging in different tools in that trade cycle is obviously arriving at a holistic solution, but leveraging a businesses, as Nick rightly put it, the traditional overdraft has limitations. So we leverage the business's assets. We leverage the debtor book. We leverage stock inventories, whether the stock is on the vessel coming over on the high seas, whether it's in the warehouse, whether it's in the manufacturing process, etc. It's still an asset in the client's balance sheet. So what we're doing is trying to leverage the non-conventional assets. When we talk assets, especially in the local market, we start thinking bricks and mortar warehouses, directors' residences, notarial deeds, hypothecs, etc., etc. In this type of finance, we try to steer clear of all that and use what's in the balance sheet itself. One final point is that there is no fits-all solution. These are all bespoke facilities. As I said before, sometimes a business will need more than one facility for different business lines. So we need to sit together, identify the need, and then fit the solution for the requirements of the clients. So without further ado, unless somebody has any questions for me, I will hand over to Andrew to give us.
I think it would be
Sorry,
best
to Julia. I'll
No,
hand
no,
it
it's
back
okay,
to
don't worry.
Julia.
I was just going to tell you, Mr. Samoud, that I think it's better we go to Mr. Robinson, and then questions can come in at a later stage.
Okay.
So we can compile them.
Okay, fine. So I'm officially handing the baton over to Julia now.
Exactly. Well, I just pass it on to Andrew. Just Gaetano, if you don't mind, stop
Yes,
sharing, please, so that Andrew can.
Okay, thank you very much, Gaetano. Thank you, Julia and Nick. As mentioned, my name is Andrew Robinson. I'm the regional head for Europe for Global Trade and Receivable Finance and HSBC. It's a pleasure to be invited by the Maltese Chamber of Commerce to present. I have a couple of short slides just to give you an indication of what we wish to talk about. Generally, what we've seen from a global perspective in the trade market, the trends that we see, partly driven by COVID and other indications or other issues regarding supply chains. Little look at working capital cycle and analysis, and a couple of case studies in how corporates have alleviated working capital needs through various products. So without further ado, I'll share my screen quickly. As I say, we just have a few screens that we can present. Is that clear, Julia? Can you see that, Gaetano? Yeah. Okay.
Yep.
So We've entitled this Opening Up a World of Opportunity, and that sort of speaks to some of the purposes and values that HSBC has recently put in place. So it's the role of the bank or the institution to try and connect through trade and capital flows our clients that are in various jurisdictions around the world. So trying to get linkages together to facilitate trade. In terms of, let me just go to the next screen. So what we've seen in the past couple of months, say 16 months from I would say what I've seen from my dining room, I haven't actually been out. I've been to Malta a few times, but I've been in my dining room for about 16 months. What have we seen? Well, in terms of the pandemic, obviously we're seeing great progress in vaccinations in various economies, but this is being, there are different speeds at how economies are converging or coming out of lockdown. Some are further ahead of others, and obviously what impact new variants may have on recovery. So a different speed in different geographies. We've seen a lot more innovation in terms of the way that we interact with clients. I think this has been a long-term, well, this has been a long-term trend of clients looking towards, and banks looking toward more digital solutions to create efficiencies and speed. And that has been accelerated greatly by the impact of COVID, partly from the reason that if you're in lockdown, you can't provide a wet signature. You're not going to a bank or a supplier and physically meeting them. You need to do these things electronically, and you need to do it safely. Sustainability is a key agenda, and this is linked to climate change, to environmental considerations, social governance, and other aspects. And actually, where we have clients that are looking at sustainability, they're on a journey of discovery in terms of their supply chain. And what that actually gives them is greater understanding of the risks that they may be facing, and that they discover when they're looking at supply chain sustainability. And I can give you one very quick example. If let's say you're a clothing manufacturer or a clothing distributor, and you're buying from markets overseas, and that particular factory uses dormitized labor, or labor that retires to a central living area in an evening. If they're exposed to a COVID pandemic, you'll be asking questions about what are their COVID, what's their PPE, their sanitation, their living conditions, in order that you may wish to assist. Okay, if you haven't assisted, the time you will find you have a problem is when the supplier says, I can't deliver. This is a big issue for large multinational corporations if they're suddenly told, sorry, but we've had to close our plant and we can't ship any goods to you, and that impacts your supply chain further down the stream. If you have an ESG agenda, you know these risks because you're investigating and inquiring. Cybersecurity, this obviously is linked to an increase in innovation and digitization. If people have seen things like the cyber attack on the Colonial Pipeline in the US, these are serious issues. These are really challenging. If you suddenly find that the distribution of fuel has been impacted, that has a major impact on the economy very, very quickly. And you can see that being applied to other areas. So obviously cyber security is key, not only interfacing with banks, but also your own systems and your other how you interact with broader counterparts. Excuse me. Open markets, we see that this slide was done a while before, this is an update of slides. At the time we were looking at Brexit, the US had a much more centralized or domestic agenda now. It's changed a little, but we still have ongoing challenges between protectionist policies, an ongoing debate, or challenges between large superpowers such as the US and Russia and China in terms of how that impacts trade. And then the global recovery, which we think will be quite strong once economies open up. There's a lot of pent-up demand. There's a lot of savings that certain members of society have had because they haven't been expending the normal things. I don't know about yourself. I haven't been to a restaurant for a long time. I'm fortunate in working in an organization that is still functioning fairly well, but obviously there's a lot of pent-up demand from people. So the key working capital considerations that we see in 2021, just expanding on a couple of areas. So at the start of the pandemic, just to give you an indication, a lot of our clients, especially in the larger businesses, the multinationals, they drew down on their working capital facilities, on their RCFs, their revolving credit. They raised more capital in terms of loans or bonds. They were preparing to have substantial liquidity buffers because they were not clear when they would come out of lockdown, when they would start to be generating cash flow. So as part of that, that's increased the oversight of treasurers being able to know what is their cash position, what's their liquidity on a daily basis, if not, and in some circumstances, hour by hour. What is the actual liquidity in the business? And I think that's an important aspect. I would actually say that's more important if you're running a smaller business where liquidity is constrained than if you're a very large business and you can always draw 10, 20, 30, $100 million on a revolving credit facility. I think the focus on a small business is much more acute to liquidity, to delays in payments or other aspects. So key focus on that, knowing what your cash flow position is. And we have tools in terms of our global liquidity and cash management business to forecast these issues. I think then we're seeing digitizing at scale. So as I've mentioned, a lot of clients getting onto proprietary systems such as HSBC Net, Swift for corporates, making that interface with banking to improve their flow of their payment instructions, and obviously that accelerate removing administration out of the system and creating efficiencies. Supply chain resilience. This is a huge issue that we're seeing, or a very large issue that we're now seeing coming along. And I think this has been, the focus on this has been much more accelerated by the pandemic. So where countries have suddenly shut down, and obviously if you're dependent upon goods being shipped to you, and obviously Malta as an island is quite exposed to the importation of goods from overseas, then obviously how is that managed? So we've had COVID that have tested that. What you can see are trends where if companies had a large dependence, say on China, we now hear China +1, China +2. So for example, to moving some of the production from maybe China to Vietnam or the Philippines. So a +1, +2 sort of area, still in the same region. We've then seen other companies supplement that with a nearshoring. So you might actually swap, you might bring production closer to your own region, say within Europe or within North America, just to ensure that you have that stability of supply. No one had really factored in a whole region shutting down. Okay, maybe a factory closing, and then you could go to another factory and country, but where the whole country is shut down, that obviously creates a different dynamic in terms of supply chain resilience. I think the issue with the Ever Given in the Suez Canal obviously alerted people. I'm sure I don't need to mention to Malta as an island seagoing faring nation, but 80% of 80% of trade is on vessels. You see a lot of people suddenly surprised that, you know, a vessel in the Suez Canal suddenly creates a huge traffic jam in shipping very, very quickly. I think there's an education piece there in how physical trade is transacted and what disruptions can occur. And then I think in terms of inventory source shortages, you'll have seen things like semiconductors, where there aren't sufficient semiconductors for various manufacturers. It started with the automotive industry. It's spilling into white goods, so goods that you need like fridges and freezers, where you have these chips that control basic functions, causing delays there. And I would argue that the traditional policies of a just-in-time or just-in-case, so inventory arriving at the factory to be bolted onto the product, if your production line has stopped, then that policy needs to be reviewed because it's not fit for purpose. You know, if you suddenly run out. So this re-emphasized potentially a need to have more stock on hand, either on your own balance sheet or through another supplier. Excuse me. And that are things that companies will need to take into account. And I think in terms of what we're seeing, inflationary pressures, we see an increased inflationary pressures on raw materials, so on commodities, on transportation in terms of containers, and on packaging materials. So all feeding into the supply chain in terms of pressure. Clearly an impact on on cash flow and earnings impact, linking in from a consequence of the previous two. And then how do managers or treasury managers manage risk and volatility in terms of fiscal packages, inflation, foreign exchange, those sort of areas to be aware of and across in terms of what may happen. So these are the key things that we've seen in 2021, and we expect to continue for the rest of the year and into 2022. If we look now at the working capital of a business, and this looks like a complex slide, but it's not really. What we do here is, for some of our clients, they ask us to do an analysis of their performance, and what we've done here is we've looked at a consumer products client. So they sell toiletries and other consumer products into the market. They're the client, they're here. And what we basically do is we do a comparison with their peer groups through other companies that are in this sector. And we look at the respective information that is public on their balance sheets. And we basically look at things like their DPOs, so their days payable outstanding. So how quickly do they pay suppliers or not? Their days inventory outstanding, how much stock do they have on hand? Their days sales outstanding, how quickly do they actually receive cash and pull cash into the business? And that all basically works within the cash conversion days. So how quickly is cash coming into the business? And when we take our client, their margins are very strong. Our margin, the gross margin here is 68%. It's extraordinary. It's very strong. But in terms of working capital, when we compare them to other clients, there are obviously some areas should they wish to seek to improve that working capital. For example, when we look at their ranking on days payable outstanding, they're 9th. Okay, so they pay fairly quickly. They pay around 45 days. Best in class is around 85. Now, obviously, there are various other factors to look into this, but obviously it gives you a guide of how can you improve and whether it's viable to look at that. Again, the days inventory outstanding, they're holding 59. They're way out in terms of other clients that are holding the same amount of inventory. Now, why is that? Are they particularly inefficient? Or is there a reason? Do they hold inventory that they need to? Have they got a different business mix? So again, it's just to highlight pointers of where to look. These are the analysis of this. Coming back to Gaetano's point, bespoke solutions to look at individual clients rather than you must have this demands an RF or something like that. What does it mean to the business? And how can we analyze that? And then the last one, day sales outstanding, they're waiting 64 days. Again, they're 13th in class. Other clients are pulling in 32 days, some 22, but they're at 64. So clearly, and this is a purely an analysis that the client can look at and say, okay, what does it? I see what it tells me. What do I want to do about it? Okay, and this is where we come into the next slide. So these are how we can optimize working capital flows and the structured solutions that HSBC has and provides to its client base. So for example, we have days payable outstanding. So these are where the client is buying goods and services. Now, clearly what you wish to be targeting is to elongate that period. If you're paying at 45, if you pay at 60, that's cash in the business for 15 days longer. Very straightforward. You're conserving cash in the business. And how can you go about doing that? So the major corporates, so the large multinational businesses, you may be familiar that they have supply chain finance programs, or sometimes called reverse factoring. And I've got an example on a case study on that. And I think it's my purpose of mentioning this to the members of the chamber is that you may be approached by some of your clients or some in your who you're selling to go onto a supply chain program. And what does that mean for you and is it a good idea, or how can you consider that? So just a hopefully an education piece onto if a large corporate is asking for this. You can also use, as we say, you can use documentary credits and bonds. There's trade loans, etc., to elongate that working cash out of the business. In terms of inventory, here we have days inventory 59 outstanding. Whether there is a ability to finance that inventory, sorry, if it's on a longer period of time, whether that's asset-based finance, lending against the stock in terms of commodities, where I have a part of the business. If I've got an underlying commodity, say fuel in a tank or copper in warehouses, that commodity has a value related to the open market, so you can generally generate a higher loan to value on those. And we are seeing in some areas what we call vendor managed inventory. So what would happen here is a supplier is holding the inventory on his or her balance sheet, maybe at a premises, and delivering that stock as and when. But obviously the supplier or the buyer of that goods, that cost of carrying that inventory will probably translate into the purchase price. So it's, you won't have it on your balance sheet, but the cost will be passed on. But you would have certainty of supply. So I think if there's a larger supplier, he's bulking up, or he or she are bulking up that supply, and other buyers have certainty that the stock is there, then that might be something to consider, maybe through a cooperative or other areas. And then the last one, which we've mentioned, which I'm sure people are familiar with, is receivables. So days sales outstanding. And here it's the receivables finance, the traditional forfeiting or receivables finance that discount funds into the business, and the bank is waiting for settlement of the receivable from the end buyer. And obviously this pushes cash into the business. So just to recap, we're looking at extending this period, funding this area of the inventory, and accelerating this. So this goes down to maybe 30 or 10 or however you can do it. This elongates, and you conserve cash by funding on the day's inventory, either by an on-balance sheet solution, so funding direct to the client, or vendor managed inventory. And I'm sure we can take some questions on that at the end of the presentation. Finally, I've got two case studies of how this works. So this is a receivables facility. So we have an IT consulting company. This is slightly unusual in that it's services as opposed to physical goods. And this is a large area that the bank is interested in, which trade providing financing for services as opposed to physical materials. This is an area that we're very interested in. A lot of new technologies and a lot of new parts of commerce are now services. For example, 10 years ago, you probably wouldn't have had your broadband, your Wi-Fi, all of this. This is now a service that we have. So this is a 120 million non-recourse, we call you've got a lot of terms here, pan-European, so across European countries, invoice finance facility. Effectively, the client has a commercial agreement with the buyer. We are financing the receivable through a receivable purchase agreement. So we're buying these receivables from the company. We can mitigate our risk through perhaps by taking insurance in terms of the buyer's insolvency. And that basically allows the client to accelerate cash flow into the company. This was key because the client had fairly high leverage, coming back to point that Gaetano raised, because it was due to a level. So this drives the working capital. Numerous buyers, but obviously for a bank like ourselves, we've got branches and capabilities across Europe, so we can accommodate these type of asks. The last one is more of given an example of the reverse receivables finance program, so a supply chain finance program. We put that in place again for a European client. They're in the manufacturing area, and they sourced a number of raw materials and commodities across many buyers in Europe or abroad. And what they're basically doing here is they are saying to the seller, they seek to extend the terms on the seller. So the seller is asked to go from maybe 30 days to 90 days. Okay, so optically, the buyer has 90 days to pay. The seller clearly doesn't really want to go from 30 days to 90 days and wait an extra 60 days for payment. However, because we have a supply chain finance program in place, the seller takes their invoice to the bank and gets that discounted within 2, 3, 5 days. So that accelerates cash into the business. So where he was previously on 30 days, he's now being able to receive those funds on day 3 to 5. So accelerating cash into the business. That's the benefit to the seller. The company itself is obviously conserving cash in the business because they are not having to pay that invoice, which is held by the bank, until say day 60 or day 90. All the same thing, elongating or accelerating flows between respective counterparties. Again, this is quite a large program. We're covering euros, dollars, sterling, several countries in Europe. These tend to be linked to larger companies. So companies that have maybe, for HSBC, turnover of above 500 million. There are dollars. There's other considerations in terms of ratings, because we're building up as a bank. We're obviously building up an exposure to the company here in terms of their future settlement of invoices for goods they've received. That is basically a quick run through in around 15-20 minutes. I hope that was okay. I will stop there and back to Julia.
Yeah, that was great. Thank you, Andrew. I see Nick has raised his hand, so I don't know if you want me to present the results of the presentation and then we can get into the.
Go ahead, Julia.
All right. Okay. So I'll be sharing my screen with the results of the poll questions. If you could just bear with me for a moment, because working with one screen is always the hardest thing to do on Zoom. So. So, share screen. So I do realize you are seeing, so are you seeing the presentation at the moment?
Yes.
Great. So I'm just going to go to the first question, and the first question is, do you expect your use of digital applications by your business to develop? So we had 33% who have expressed that they have already increased over the past 18 months, but are not expecting to expand further. But 52% have said that using digital tools and looking further to expand their use. So digitalization, as we can see, is very, very much.
I think that's a fantastic result personally, in terms of where we see requirements and everybody having to look at digital. I think that's a very strong result.
No, it's great, because we have policies coming in all the time, and even the Green Deal from the EU side at least, and we are always saying technology being seen as not the disruptor but the accelerator towards change. So I think the fact that digitalization is being incorporated in everything, to be honest, I think it should be part of everybody's business plan and everybody's marketing budget. So I do believe that this is really, really great news. I agree with you on there, Andrew. The second question is resilience of my supply chain now and into the future. So 33% have said that it's stable, they have no concerns. 17% said I have reviewed and taken action, and 26% have said I think I may need to review. So there is sort of balance here in terms of supply chain, and again, at least in Malta, due to Brexit and even due to COVID, there have been a lot of issues in supply chain, and I think this very much reflects that. I don't know if you have any instinctual thoughts on this, or perhaps Nick, as a manufacturing company, you might.
It shows there are different businesses in different industries, so you can see some businesses affected, some are not. The manufacturing industry in general is being impacted, and I'd say more the impact is coming more out of Asia. I wouldn't say just only out of Asia, but the issues coming out of Asia are quite big at the moment. You've got costs which are going 3-4 times as high, but worse than that. Containers which have been caught up on the US side but need to be in Asia. There's lack of containers. So that's what's happening is deliveries are being delayed 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks. I mean, there are some shipments I've seen that have been delayed quite a few weeks. So I'd say a lot of manufacturing companies must be facing, and definitely I see that quite a few issues in this area.
I think, Nick, it's flexibility. I think it's be prepared to, you know, the norms of maybe it's the ability to suddenly say, okay, what if I suddenly have a challenge? Where can I pivot somewhere else? Do I have relations with other suppliers that are near? It may be an issue that there is obviously a price issue, but a timing issue. If you can get goods further in, they may be, the closer goods may be more expensive, but you maybe have certainty of when they will arrive. I think it's to be, from what we speak with our clients, it's where they're looking at more to flexibility. I think the idea that I will only supply from China is something that needs to be considered. Is that going to be as resilient as it was previously? I think that's a key question.
And Andrew, if I may, it's also an opportunity for many businesses as well, because if you're looking at a challenging supply chain, it's great to have better options and also explore better quality in some cases.
And so perhaps bring in competition.
Yeah, exactly. It increases competitiveness as well. And yeah, but it's something that is being discussed even at EU level, and the importance of diversifying your supply chain in order to remain competitive. And it's great that we have people thinking that they need to review. But I'm also happy that 26% have no concerns.
longer term, it's going to put concerns on I think, picking on Andrew's point, dependence on China. So do you onshore more so in the industry I work in? There's a big push over the last few years. So this is going to accelerate that, to be less dependent on China and bring more production back into you.
Yeah, if we just quickly go back, we're back on that slide. I think the other aspect that we've seen is are you dealing with is your supplier's supply chain as robust as you think it is? So let's say, for example, you're based in Malta, you're buying from a supplier in, I don't know, in Italy, but are they sourcing their goods from outside of the region? And what we've seen, excuse me, what we have seen, for example, we had a large multinational corporation that was dependent upon a local trucking company in one jurisdiction, a family control business. They represented about 40% of the turnover of that trucking business. But when the business had to close down, or the domestic part was closed, that business cannot run on 40% of its revenue. So suddenly there's the major multinational is saying, so what do I do about this? And they may have to provide assistance to that company. So that tier 3 supplier, in terms of dependency, suddenly becomes tier 1. So I would also check that just because you have a very strong supplier, let's say in country, what is their supply chain doing? How do they source? And I think that's another area just to be aware of. It's an ongoing, I think it's ongoing management now.
Okay, so the next question was, which section of your trade cycle engages and ties up with your working capital for the longest time? So we had a 67%, which selected payment realized, payment received. And we had an equal 17% on goods purchase on order to delivery, and value adding and 2-time goods are delivered / shipped. So yeah, payments.
So this is payment. So Gaetano, this is your receivables.
This is my receivables finance opportunity. I knew that this was a major headache, but 67% is, you know, taking me by surprise a bit. And this is where obviously the receivables finance program comes in. I'm not trying to sell my product. A lot of banks sell receivables finance. So, but it's statistically proven that when we go in, so there are various variants of receivables finance. We can collect the money ourselves if the client so requests, at a cost, of course, but for the maintenance costs obviously increase, but it's a minimal cost. But it's proven, statistically proven, that when banks actually go in, so it's our line, it's our core line of work, right? We lend money and then we collect it back. That's the core raison d'être of a bank.
Yeah.
So we believe we are much better placed to collect and maybe put a bit of pressure on your buyers than maybe a seller in isolation would. Statistically, we've tracked and we've seen like an improvement of anything between 30 and 40% in collection when we step in. I don't like to publicize this functionality, to be honest, because it's human resources hungry, it's human resources intensive. But if the case so requires, we will consider it. Again, that 67% is awesome.
If I may, Gaetano, maybe someone in our audience who selected payment realized and received can write in the Q&A or the chat and say why they chose that option. You can remain anonymous if you wish. I don't need to publish your name.
With all respect to, we know that if you give a client 60 days, it means that on the 60th day the culture is changing. Mind you, there was a vast improvement in the last 10 years, but the culture is still a bit. So with 60 days, you start thinking of paying on the 68th day, not you pay on the 68th day. Unfortunately, there's still an element of that bad old culture going in. And being a small market, where seller probably knows the buyer very intimately sometimes, a sort of complacency creeps in and suddenly it gets out of hand. So yes, I would have expected a figure, a quite high percentage in that grey box, in that grey segment, but still I'm surprised at the number.
Not that high, perhaps more towards 50s.
I would have expected it to be about 40%, to be honest, but 67% is.
Like I said, I invite anyone who has anything to say about that to put it in the chat, even anonymously, and we'll see what the reason was. In the meantime, I'm going to stop sharing my screen because we've had a couple of questions from the audience, and there was one. It's quite an extensive question, so it may need to be answered in part. But anyone who can answer it, please feel free to interject. When dealing with large organizations and offer to issue a letter of credit, most of the time these insist on advance payments due to the small nature of the orders compared to larger buyers in other countries. Is there a way that HSBC can assist in this regard? He goes on to say, on the other end of the transaction, when we are exploring the opportunity to export and ask our buyers for cash in advance, to mitigate our risk, we are often offered a documentary collection option or a letter of credit in our favor. Is using these products a safe alternative to cash in advance?
Should I take it, Andrew?
Please go ahead.
Yes, this is an endemic in Malta. We're a small market, so if you're an importer and seeking to buy, it's a seller's market, and on the other hand, if you're an exporter seeking to sell, it's a buyer's market on the other hand. So we get it both ways. The last bit of the question is the easier part. Yes, we would suggest letters of credit. They mitigate your risk. They guarantee your payment. Obviously, a letter of credit is only as worth as the bank issuing it. So people need to consider first and foremost the country risk of where it's coming from, because the institution issuing it can be the biggest bank in the world if the jurisdiction it's coming out from is the legal framework isn't so up to scratch. It can be mandated or injuncted or whatever. So the first and foremost is the country risk, than the issuer risk. So LNLC, a letter of credit, is only, or a guarantee, a bank guarantee, is only as worth as the guy who issues it. Finally, having said that, we obviously all the time advise and counsel the usage LCs. LCs protect your payment. LCs can give comfort and peace of mind all through your production cycle. So you're not producing goods and finally you're not going to ship because the payment hasn't arrived yet. The payment is guaranteed before you start even putting raw material in the process or whatever. So yes, we do counsel that.
Yeah.
The other bit of the question is, the first bit is the difficult part. We frown on advance payments. Again, we find the usual typical answers coming back from Maltese buyers, from Maltese importers would be, we've been dealing with these guys for the past 20, 30 years. I've been to his sister's wedding and he's been to my daughter's Holy Communion and you know, all sorts of, it goes on and on and on. What I personally counter is that he can be your dear brother. If he goes bankrupt, he's not going to pay you. So yes, even if you're dealing with the big names of this world, try and protect your position. Import LCs, try and pay when the goods, at least when the goods arrive, not at least you see them. So you're always limiting your risk window. It's not easy. It's not easy. It's as I said before.
Yeah.
But we do arrive. We do arrive. And sometimes again, it makes me wonder, using the group, HSBC's group presence in the various countries, what a chat from a guy, if you're dealing with a Spanish supplier and somebody from Madrid gives this guy a ring, hearing a familiar voice with the same language, same culture, what difference that makes.
Yeah.
It's nothing tangible, it's nothing, but the difference it makes, it always, so I've been in this business quite a bit now, but it always amazes me. And
yeah, I think that comes back to the connecting, you know, connecting people and opening up the world of opportunity from our side, and connecting people and clients together. I just very quickly say on the 2 points there, on the first one, if you're asked to make an advance payment, then is there an advance payment guarantee back in your favor? For example, if you're supplying that, do you want a guarantee for that? So you can say, okay, I'll make an advance payment, but I'd like a guarantee back that if I perform, you know, that my money is not lost. I think the other aspect is on the letter of credit. I mean, it is a safe alternative. It's obviously cash in your account is better than a letter of credit in your favor, clearly. But I would say if you are using letters of credit, then please, you need to recognize that, are you experienced in that area? Are you, because you have to provide the documentation that will allow that letter, that presentation of documents will be a compliant presentation. If you don't make a compliant presentation, then you will have difficulty because it will be a discrepancy. So if you're not fully familiar with that, speak to a trade representative or your trade department in your banks and get familiar with what you need to do.
I can give a practical perspective. So in the first instance, from experience I've had, I agree very much with my colleagues from HSBC. If you're making a payment, an advance payment, the risk, I think, is pretty high. And I recall, but I can't remember the details of an instance where I was working in a company and made a payment that at a point in time that advance payment was lost because, say, the company went bankrupt. You're buying a piece of equipment, you pay 30% down, this just vanishes. So using another instrument that the banks can provide, like letters of credit, is definitely the right thing to do. In the second instance, looking at it from a practical perspective, cash in advance is always the best way if you want, especially because high risks of having cash in your account is, even within our organization, is always #1 preferred option. But obviously, the customer on the other side very often says, I don't want to pay cash because I've got nothing in my hand. Same way when we were purchasing. So again, using a different number of products that are available can mitigate the risk and appease both parties. So again, this is from a practical perspective.
Exactly. This is what we call the risk ladder, Nick. It's what's good for the buyer is inversely bad for the seller, and vice versa. So the letter of credit would come bang in the middle. It gives protection to the buyer and it gives protection to the seller as well.
Can I ask?
But Andrew's point is very valid. NLC is a complicated and a complex bit of part of that famous toolbox Nick mentioned in the beginning. And yes, please consult a trade representative before committing to an NLC text and then finding out you cannot comply with the requirements. So some of the requirements would be very demanding, very complex, very document heavy. So please do comply with us or with your bankers before committing to a letter of credit.
In fact, Gaetan, I want to highlight this point. What is it exactly that you would require? If it's too vast, I mean, maybe you can point on 3 things that you would require.
In essence, the normal letter of credit would require 3 main documents. The typical ones: the invoice, a transport document, an original transport document, and maybe a packing list or something like that. Then it becomes complicated because some importers would require a certificate of verification from people like
certificate of origin, for instance,
and then certificates of origin, certificates of medical health. Some countries will have legislations and jurisdictions requiring each inch thick piles of documents. Each document has to comply exactly with the other one and with the letter of credit itself. Sometimes initially it's at a glance we can see that it's impossible to do. So if this letter of credit is a typical example, the letter of credit wanted a document signed by a consulate of a nation which was non-existent in Malta. So this guy would our seller would have had to go to South America to get the stamp or whatever, and so that was not workable outright. So
I think
producing because you have an LC, because that is not workable.
I think from our data we estimate that about 60 to 70% of letters of credit have some form of discrepancy. Now that's not to say that 70% don't get paid. They get paid, but you're not, if your buyer or the applicant to the letter of credit needs to accept the document, that's not a firm letter of credit. You're then back on that. They have to accept it. And if you've shipped, then clearly you have a challenge, right? It's because if that's not accepted. So this is why.
If you produced for specific goods which you can't freely sell in the open market, for example.
So what we're also seeing, and it links back to digitization, is when we use things like a blockchain or our platform is Contour, where because you reduce those mistakes, you're generally trying to get that much quicker. So reduce discrepancies, reduce overall cost, and to allow transactions to be at a lower value. So typically with so we have a blockchain platform that we're in consortium with another group of several banks globally, and it's trying to ensure that those discrepancies does not occur because everybody's working on the same documentation and wording that they know at the same time. It's a complicated process. It's a very inefficient process at the moment. I think the last innovation in trade was the 40-foot container.
We have time for a couple of questions because I can see that we've received more. There's one I don't know if it's exactly the remit of this, but so if you can't answer it, feel free to tell me that you can't. But how HSBC can support to build a business in Malta? I don't know if this is the right remit for.
The proper answer would be to contact a bank representative, trade representative, and we'll go through the works because there's so many variables in that question, which but we would be delighted to guide people. We have, various what we call segments: large corporates, business banking, small business banking, etc., etc. Who would be delighted to guide this individual through the hurdles of getting bank support in whatever
I think
they are doing.
someone commented to your joke, Andrew, about I think this is what it's meant. We received a comment about the high cube 40-footer. I'm
Yeah.
assuming it's a joke. I don't get the joke, but I'm assuming it's a joke.
Yeah. I think this is the one of the great inventions in trade. We're trying to make that much more digital. So yeah.
Okay. Also, there was a question that was posed about freight costs. Do you think those are going to continue increasing during COVID in a post-COVID world?
I think from what we've seen from some of our clients, there's very much a concern that containers are out of place. So it's quite cheap to move a container from, I think, North America to the States because they're empty. But I think in terms of, I think Nick may have mentioned that in terms of, we've seen a lot of challenges where it's fourfold from China to Europe in terms of cost. I think somebody's $16,000, something like this, from maybe 4,000, something like that.
No, you're not far off with the 16,000, Andrew.
Yeah. So this is sort of a more feeds into what we were saying before about is that current cost of moving goods from Asia replicated or does it cost the same or less to go near shore to a closer supplier? So you've got that $12,000 differential. That's what we're saying about the flexibility of supply chains and looking at alternate suppliers that are they available.
And the problem we are seeing is that despite people willing to pay the $15,000, $16,000, they're not finding the capacity.
Yeah.
Which is even more alarming.
Yeah. I think ultimately it will probably even out. Well, I think longer term you will see that are there enough containers to finance world trade? Yes, but they're in the wrong position at the moment. Would you agree, Nick? I mean, I don't think there's a shortage. They're just in the wrong place.
Yeah, what we see is there's a lot of containers caught on the US side.
Yeah.
As during the pandemic, there's a lot of export out of China, and a lot landed in California, and there's lots of empty containers in California, and lack of containers mainly in China. So that's what we are seeing as one of the main causes of this current supply chain, and therefore freight costs surcharge.
I think the other aspect which is coming further into people's thinking is the emissions from vessels in terms of the let's say the miles traveled for goods, and whether that will become if there's a carbon tax if you're using bunker fuel as opposed to a ship with a scrubber or some other elements, that will be potentially factored into the cost. So again, what is the dynamic? What is the ultimate benefit going to be? If you can source from a closer area, is it cheaper in terms of the carbon that is used or not? Or those are dynamics that we see unfolding in the next well, now and in the next few years.
Going to increase.
Yeah, I don't know if we have. I can pull another 5 minutes, so we don't delay anything. But I don't know if you have any other remarks that you want to mention that hasn't already been mentioned, or any takeaways that you really want the audience to go away with.
One question was a little bit different, maybe, and I don't know if there's an answer from either Gaetan or Andrew. One thing which I think governments have supported businesses throughout the pandemic. Had they not done that, and a lot of businesses would have gone out of business. But once governments close the taps, I don't know, there may be the possibility that businesses, not talking more now, I'm talking a bit more global, especially in the Western world, where the government closes the tap, they don't have the funding coming in, and we're going to see some customers go bust. So obviously that's going to affect companies that are expecting to get paid from these companies, yes? So I don't know, from the banks, do you see, what is the recommendation? Are there solutions? What do you see? How do you see this? I know it's a tough question, but I think it's something that's going to affect businesses, especially those that are export-oriented or international.
I think from our side, you need to be very clear or ensure that you're aware of what are the terms when, let's say, the support, when these financings fall due for either repayment or reimbursement. and how do you manage, coming back to the first point, how do you manage your working capital, your liquidity? Are those loans going to start, or those funding start to are they linked to your cash flow? What I would be urging is that if there is a disconnect between a specific time of when a loan falls due for repayment and actually when you've opened your business, then I think you need the intention of governments was to support these businesses and make sure they continue, not to suddenly get their money back and not have the business develop. I think I would be in very close contact with your bankers, with the government, that agency that provided the funding, and make sure you've got, as with anything on finance and trade, is to understand what the parameters are. Don't be silent, have a dialogue, see what the issue is, talk to the bankers. We're looking at how we can assist these companies rebuild their balance sheets and their working capital, but obviously it has to be a viable business in terms of where they sit. Gaetano, you would probably be very much on from your perspective in Malta.
Yes, I totally agree about that. I mean, the local aid was actually pretty generous, and I believe it's over 4 years. So you can, but you have to ask the question to the. It's coming from the Malta Development Bank, so people need to sit down with them, and obviously now the situation is, I was going to say it's becoming clearer, but probably it's becoming more murky, because nobody expected freight costs to rise by 500%, and nobody expected some raw materials, some commodities to increase by 60 and 70%. Yesterday we had a case, we're analyzing and investigating a case where the client, to sell the same volume of material, needs an increase of about 70% in facilities. This just to sell the same volume he used to sell pre-COVID. And during COVID, really and truly, because the hike started very, very recently.
Yeah.
So it's very real. Yes, I love that idea, to sit down as early as possible with the authorities, to see if the businesses are in a position to repay what they signed up for last year. 12 months have passed now, and what I'm remembering now, I'm going to give a hint about my age, which isn't pretty. I remember 2008 crash, and the mantra coming out of that crash and the statistics coming out of that crash was more businesses, by far more businesses, failed in the recovery period than in the actual crash itself. Because the dangers in the market will recover, but it won't be the same market. So if people go in and rush, one, with a false hope of recovery, two, that maybe their particular markets are not going to recover, other markets will recover, or the geographical location will change, as Andrew has been saying. People are near shoring now, so it's much more dangerous coming out in the recovery period. Wrong investment decisions maybe, or
I think in any debate or any engagement with whether it's bankers or other financiers or government support, it comes back to what we've been saying before at the very start. You need to know what your working capital cycle is, what your liquidity is, what you'll be able to forecast your cash flows. Have some contingency in there, so you know what you'll be able to produce cash flow modeling in terms of what you expect payments and things and receipts and payments to happen. So you've got a grasp on the business, because if you don't have that visibility, then you don't instill the confidence in the people that you're on top of running the business from a cash flow perspective. And at the moment, whilst businesses recover, are they going to immediately turn super profitable? Probably not, but they need to get that stability to still be cash flow, let's say cash flow neutral, so that they're not going further into debt. They may be coming up, and then they're building profitability as they go back. It's similar to Gaetano. I remember these cycles many years ago, and in 2008 and before that as well. So these are the key. The things have not really changed. in terms of each crisis. It's the same thing,
I
information.
think the key theme in this is the ability to adapt, flexibility.
Yeah.
So I think that's more than resilience, because you know, during the recovery period you can get help and you can be resilient during the market. I think the next step would be flexibility and how I can not just stay afloat, but actually turn my business into something competitive. And the Chamber has spoken a lot regarding re-engineering over the past year. So re-engineering your business model to fit with the new requirements, with the new norm. Perhaps Nick can, if you want to interject in this point, because I know you were part of council last year. So, but yeah, we did emphasize on the importance of re-engineering your business to stay competitive as possible and in the new market. And I think this theme will continue being recurrent. So it's good that we're on the same page at least.
Yeah.
So I don't know if anyone has any other closing remarks. We are running slightly late, but it's not a problem. I've noticed that the participants have stayed with us, so thank you for that. It means that everyone enjoyed the session and nobody got bored. So congratulations to the speakers for that. So I don't know if you want to close off, Gaetano. I'll start with you, finish with Andrew, and then obviously Nick. The best for last, Nick.
Okay, so thank you for participating. Thank you for giving us your valuable time. I hope that we have shared some valued information. Please do consult with your bankers before going into unknown territory. That is the message which sticks most. Be it HSBC, be it your bankers, doesn't matter. Please do consult, especially when going into unknown territory or relatively unknown territory. Thank you.
Thanks.
Thank you, Gaetano. Andrew?
Yeah, I think I just hope the presentation was useful in terms of it's the key themes that we keep saying. I was very encouraged by the polls in terms of they reflected some of the views that we had, which is always good to know. Great. Because obviously what our clients are thinking is very important to us. That needs to be grounded in not just what I think, but what his clients think. And I think I'm going into the office tomorrow for the first time since the 24th of March 2020.
Really?
And I hope that I will be able to meet you members of the Chamber and clients and Gaetano again in Malta in the near future. I think face-to-face is where business is done.
Andrew.
Face-to-face is where business is done. And as much as I like Zoom, I don't like it that much.
Andrew, I did tell you last time when we were chatting for the first time that you're always welcome at the Chamber, and that we can have a coffee here. I'm sure Nick would be very excited to show you the history of the Chamber.
I'd be delighted. Thank you.
So not a problem. We look forward to having you, and I really, really hope that it doesn't rain tomorrow the minute you exit your house. So Nick, any last thoughts from your end?
Well, first of all, I'd like to thank Gaetano and Andrew for giving us a really interesting insight into the trade finance cycle and how businesses could get help from the banks to finance their trade cycle. I mean, the only message I'd leave more from a practical perspective is there are a number of tools that businesses could really use. And two areas which, from my experience, have been really, really helpful is one is if you want to internationalize, especially because that I think the remit is much wider, the risks are much bigger, and therefore the tools available, coming back to the toolbox, the banks can offer quite a lot of tools that any normal business would normally be possibly aware of. And also, if you're looking to scale up your business, so scaling up a business, you're looking for growth, this is a really good tool that could be used, or a number of tools that could be used to finance businesses. So do speak to the banks. I think we've had some really good insights today. And thank you, Julia, for your excellent chairing of this event. Well done, really well run.
Thank you. Great.
Thank you all.
Thank you very, very much. Have a lovely afternoon, everyone, and to you too, Andrew.
Thank you very much.
I really do hope it doesn't rain tomorrow.
I'm sure it'll be fine. Thanks.
Thank
Bye.
you. Bye-bye, everyone.